Hi. Hello, fellow investors. Today we will explore financial speculation events. By learning from the past, we can gain insight into the future. The idiom, "a stone from another mountain can be used to polish jade," suggests that we can learn from others' mistakes. The repeated occurrence of financial speculation events reveals the complex relationship between human nature and markets. These events not only challenge economic systems, but also reflect societal psychology and policy decisions. We will analyze these phenomena from different perspectives. The nature of financial speculation, human nature, and greed. Financial speculation often stems from human greed and fear. Investors, in pursuit of quick profits, often ignore risks, leading to irrational asset price inflation. For example, in numerous historical financial bubbles, investors believed the market would not crash, and this collective mindset fueled the bubble's growth until it ultimately burst. Challenges to market efficiency. The efficient market hypothesis suggests that market prices reflect all available information. However, financial speculation events show that markets are not always efficient. Irrational investor behavior and emotional fluctuations often lead to prices deviating from their intrinsic value. For instance, the subprime mortgage crisis and subsequent financial meltdown were triggered by excessive credit and derivative trading. Review and analysis of major financial speculation events. 1637. Tulip mania. Background: tulip mania occurred in the Netherlands and is the first recorded speculative bubble in history. At that time, tulips became a luxury item, and prices soared. Causes social psychology. A surge in demand for tulips led to price increases. Speculative behavior. Many investors engaged in speculative purchases, hoping for profits. Impact: economic collapse. After the bubble burst, many investors went bankrupt, causing significant damage to the Dutch economy. Decline in market confidence. This event weakened public confidence in the market. 1690. England's stock craze. Background: the English stock market developed rapidly at the end of the 17th century, attracting a large number of investors. Causes financial innovation. The emergence of new companies and stocks spurred investment enthusiasm. Public enthusiasm. Interest in the stock market surged, creating a stock craze across the nation. Impact: increased market volatility. A large influx of new participants led to heightened market volatility. Economic instability. As the bubble formed, the economic system became more fragile. 1720. South Sea Bubble. Background: the South Sea Company was established in 1711 to manage Britain's trade with South America. Causes excessive speculation. Investors were overly optimistic about the company's future, leading to a skyrocketing stock price. Government intervention. Government support for the company encouraged more people to invest. That impact: economic collapse. After the bubble burst, tens of thousands of investors suffered losses. Financial regulatory reform. The British government strengthened financial market regulation. 1929. The Great Depression. Background: in the 1920s, the U.S. economy was booming and the stock market was steadily rising. Causes excessive leverage. Many investors borrowed money to buy stocks, creating market bubble. Economic imbalance. Industrial overproduction coexisted with insufficient consumer demand. Impact: global economic collapse. The Great Depression led to skyrocketing unemployment and economic contraction. Policy reform. It prompted U.S. government intervention and regulatory reform of the financial markets. 1980. U.S. junk bonds and Japan's economic bubble. U.S. Junk bonds. Background: in the 1980s, the U.S. saw the rise of high-yield but extremely risky junk bonds. Causes increased demand in a high-interest rate environment. Increased corporate acquisition activity. That impact: increased financial crisis risk. Promoted the standardization of the bond market. Japan's economic bubble. Background: in the late 1980s, Japan's economy grew rapidly, with real estate and stock prices soaring. Causes low interest rate policies. Excessive credit expansion. Impact: the lost decade of the 1990s. Long-term economic stagnation and structural problems. 2000. The dot-com bubble. Background: with the rapid development of internet technology, many tech companies went public. Causes overly optimistic market expectations. Large inflows of venture capital that impact stock market collapse and company bankruptcies. More cautious evaluations of tech companies point 2008. The financial crisis background: the global financial system was impacted by the subprime mortgage crisis, triggering a large-scale financial crisis that causes bad loans and complex financial products. Lack of regulation and moral hazard that impact global economic recession. Strengthen financial regulatory systems. Common themes in historical financial speculation events: bubble formation. All of these events involved the irrational rise in asset prices, forming a bubble. Investors, driven by overly optimistic expectations of future returns, push prices far beyond their intrinsic value. Speculative behavior: psychological factors, collective psychology, and social emotions played a key role in these events. Greed, fear, and herd mentality caused rapid shifts in market sentiment, fueling the formation and bursting of bubbles. Lack of regulation in many events. Financial market regulations were either insufficient or poorly enforced, allowing high-risk investment behavior to spread, ultimately leading to the accumulation of systemic risks. Economic impact: these events affected not only the wealth of participants, but also had far-reaching consequences for the broader economy, including recessions, rising unemployment, and re-evaluation of future policies. Historical lessons: each crisis led to reflections on the mechanisms and regulatory policies of financial markets to prevent similar events from happening again. These historical events have become important cases in financial education. Through the above analysis, it is evident that while these historical speculative events occurred in different times and contexts, they share many similarities. These common points provide important perspectives for understanding the dynamics of financial markets. Modern impacts of historical financial events: market volatility. Historical speculation events, such as the 2008 financial crisis, have led to market instability. Modern financial markets are still affected by emotions and speculative behavior, and investors often react extremely to uncertainty, causing significant price fluctuations. Evolution of regulatory policies: after every major financial crisis, governments and regulatory agencies usually strengthen regulation of financial markets. For example, after the 2008 financial crisis, the U.S. passed the Dodd-Frank Act to enhance the transparency and stability of the financial system. This trend continues, with countries continuously adjusting and improving their regulatory frameworks to prevent systemic risks. Investor education and awareness: historical events have prompted investors to place greater emphasis on risk management and investment education. Modern investors are increasingly aware of the importance of asset allocation, diversification, and long-term holding to avoid repeating past mistakes. Technological advancement and information transparency: with technological advancements, information in modern financial markets spreads much faster. While this helps improve market transparency, it may also exacerbate short-term speculative behavior. Social media and online trading platforms make it easier for retail investors to participate in the market, a phenomenon already evident during the dot-com bubble. Economic cycles and policy responses: historical patterns of economic recessions and recoveries provide reference points for modern economic policy. Governments often respond to economic slowdowns by adopting monetary easing and fiscal stimulus measures, and the effectiveness of these policies continues to be tested. The continued influence of psychological factors: collective psychology still plays an important role in modern markets. Investor behavior is driven by fear and greed, with emotional fluctuations particularly evident during market crashes. For example, during the COVID-19 pandemic, markets experienced sharp volatility, reflecting the fragility of investor psychology. Through these lenses, it is clear that historical financial speculation events not only shaped the economic environments of their time, but also had profound impacts on the operation of modern financial markets, regulatory policies, investor behavior, and more. These lessons remind us that while pursuing profits, we must also remain vigilant of potential risks.